Hey guys, John Hunter, your mortgage guy, coming to you again this week with another quick video. This one on the simple way to calculate your max mortgage payment. So, when as a lender we calculate what you qualify for when we do a pre-approval, right? It's not about, oh, how many hundreds of thousands do you qualify for? It's what is the max mortgage payment you qualify for, and then we work backwards to figure out what would that mean as far as a loan. So based on your down payment and whatnot, we figure out, okay, if you qualify for $3,000 mortgage payment, what is the maximum you would finance given how much your down payment is, credit score, whatnot. So we go at it backwards. So let's talk about how do we calculate that. So the ideas I'm going to talk about really are kind of general idea. FHA, VA can be a little bit more flexible. Conventional can be a little stricter. USDA is stricter than anybody. So it does vary from product to product, but this will give you a general idea. So what is debt to income ratio? So debt to income ratio is basically your mortgage payment and your debt divided by your before tax income. So we look at two ratios, what we call front end and back end. Front end ratio is the proposed mortgage payment divided by your income. Now, they don't like that to exceed, say, 41 to a max of maybe 46% of your before income or before tax income. And your proposed mortgage payment plus your debt, your consumer debt, that is not to exceed 50% in most cases. VA sometimes and FHA can go a little bit above that with good credit and whatnot. But as a rule, 50% is a pretty good rule. So let's talk about what equals a payment, though. So a payment that we use for qualifying is not just the mortgage payment you make to the mortgage company. It is principal and interest, taxes and insurance. That has to include mortgage insurance too, not just homeowners insurance. That's part of the payment you make to the mortgage company. But we're also going to factor in homeowners insurance. So, I mean, not homeowners insurance, homeowners dues. So the association dues. Now, if you live in a neighborhood, that could be $25 a month. It could be next to nothing. Or it could be $1,000 a month if you're in a condo. And, most condo dues aren't that high, but they often are. So that can significantly change what you qualify for. So when I pre-approve somebody on a house, what they qualify for a max purchase price will vary because of the dues will vary. And makes that a little bit of a moving target, right? Because really what I'm qualifying you for is a max payment. And so the dues can affect that dramatically on condos. So we do count that. So housing expense as a total is what we're looking at. Now, as far as debt's concerned, we're not looking at cell phone payments, things like reoccurring payments like that, but we are going to look at child support. We are going to look at student loans. Student loan is a variable one, because it could be deferred for you. It could be deferred even for several years. But if you're going to have a payment due, remember, this is a 30-year mortgage in most cases we're talking about. We're going to look at what will that payment be eventually if we see it coming. Now, if they'll document it zero, very often I can use that zero. Or if they won't document what the payment is, they make me use a percentage. On the high end, it's 1% of the total. Most of the time, it's 0.5% of the total balance owed. So, but it usually benefits us to document what the actual payment's going to be because a lot of times it's lower. And sometimes it's even zero. I just had one for a doctor that was zero, even though she had a lot of student loans. But because it was based on the income as a resident before she was really making any money, the payment they were willing to document was zero, so I didn't count it. So student loans matter. It's something that a lot of times people don't factor in, but you have to. It's something we're going to have to look at. So been a hot button for several years. Anyway, so income is not necessarily what you're making today. If you get overtime, you get bonus, you're self-employed, you get commission. We're going to take an average, right? I look at it this way. It's a double-edged sword. We're not going to base the income off your best month or your best 3 months even. We're going to look at it as over time, usually 1 to 2 years, usually 2 years. We're going to take an average. So you don't get penalized if you're having a slow month or if it's a slow season for you. Let's say it's wintertime and you're in construction. But then again, you're also not going to get the benefit of your best month either. So they're going to look at that as an average. It makes sense, right? They do the same with bonus, stock options, that kind of thing. We're going to look at averages. So that's how we calculate income. Now, one other thing is a lot of income is tax-free. Disability income specifically, or child support income is tax-free. Fannie Mae recently came out with a guideline that allow us to gross up to 125% of the amount for qualifying. So if it's $1,000 in child support, I could use $1,250 in some cases. Now, 115% is pretty standard for a lot of government products, but up to 125 on conventional. That gives us a different baseline for what you will qualify for. So determining what your income is first spot. Then you determine what your debt is. Then you can back it out and figure out what is the max payment I could afford based on these general guidelines. So, but if you want to get specific, because credit score can vary, it can be a little bit less flexible, a little bit more flexible. The loan type, it can determine that. VA is a lot more flexible than, say, any other type of loan. Conventional can be in the middle of the road. Some products are flexible, some are not. So if you want to know, give me a call. I'd love to help you with it. This is what I do. This is how we determine what you qualify for. Like I said, it's not about how much in hundreds of thousands of dollars will you qualify for. It is what is your max payment. And then we figure out that dollar figure. So this is where it all starts. So that's the quick and down and dirty version of it, guys. I hope you like it. Putting out more content like this every week. Please come back, like, subscribe. Do a rate update every Friday. Come back for that. Got some good stuff coming up in the next several months. I do believe it's going to be a little roller coaster between now and then, though. So if you want to stay on top of it, please like and subscribe. So John Hunter, your mortgage guy. I will talk to you soon. Bye-bye.